In this video, I'll be continuing Chapter 6 assignment that's in Connect and move on to problem 6-6. Here we have two potential components of revenue. One is the fixed payment for the primary service, which is the elevator maintenance. I changed the value to $75,000. You'll have a different value here. And then there's a potential for a fixed bonus if there are no delays in the contract. So we have three different sets of assumptions and scenarios here that, while the scenarios relate, the assumptions are changed. So in the first assumption, the date is January 1st, the elevator service company, in this case it's Superrise Incorporated, believes that they will not be able to execute the contract without delays, so they will not qualify for the bonus. And if they believe, given the limited access to the elevator system, that they will not be able to earn the bonus, then they just ignore it. So in the first journal entry, we'll record the cash received of $75,000 in my case, and then the deferred revenue liability, since they haven't earned anything on the state, of $75,000. So they'll have this deferred revenue liability. Things change in the second situation now. This is on January 31st, and they believe that they will now earn the bonus. So they record a bonus receivable for the month of January, since it's now the 31st of January. And the $4,000 bonus receivable is 1/10 of the bonus, because it's a 10-month contract. So 4,000 divided by 10 is, pardon me, 40,000 divided by 10 is 4,000. Also, over the course of the first month, they've earned 1/10 of the contract amount, which is $75,000 in my case. And so 1/10 of 75,000 is 7,500, and they book revenue for the month of January under these sets of assumptions at 11,500. And then over to May 31st, things change a little bit. Half the contract is done, and now they believe that they will, in fact, qualify for the bonus. Initially, they thought they would not, and you'll notice that it refers you to requirement 1, where they thought they would not qualify. Now it's May 31st. On January 1st, they thought they would not qualify. And now on May 31st, they believe they will, in fact, qualify for the bonus. And so they book those first 5 months of $20,000. So they have 4,000 times, which is a monthly rate on the bonus, times 5 months, which is 20,000. So half of the bonus is earned. Because at this point, on May 31st, while they initially thought they would not qualify, they discovered that they will qualify, very likely qualify. So they book the receivable. They'll do their normal recognition of the accrual of the $7,500, which is 1/10 of the contract price, and then they'll combine the two as their revenue for that as of May. So as of May, they're going to book the entire $20,000 of revenue on the bonus, because now they believe they will earn it, as we said. All right, so just shows the effect in problem 6-6 of changes in understandings or assumptions over time on a contract with a variable or contingent consideration component, which is the bonus in this case. The exercise now, we'll move over to exercises. This exercise is just an allocation of the bundled price. And the bundled price, I should scroll down here. The bundled price is $1,900. Standalone for the TV, and using my adjusted number, is $1,775. Standalone for the remote, $100. Standalone for the installation service is $200. So we've got the standalones given, and we've got the bundled price given. Now it's just a matter of using these standalone values as a method or a basis upon which to allocate the bundled price by determining their respective percentages. So for example, if we look at the percentage of price allocated to the TV, we'll take the $1,775 and divide it by the sum of the standalone prices, and that's 86%, and we'll do the same process for the next two standalones. And then we'll just take these percentages and apply them against the bundled price of $1,900, and that will give us the total allocation of the three, in this case the three performance obligations under the bundle. If you have any questions, I'll just show this. These are now down to the brief exercises. The brief exercises that you have in Connect relate to brief exercise 621 and 612. Again, you can pause this and I will highlight some of the formulas here in case you want to stop it at any point and review what I've done. It's kind of a straightforward process. So the formula is listed up here. Very short exercise, of course. The last thing I wanted to go over, and then I have a note here too you can read if you'd like to regarding your other assignment in Connect. Nothing new we haven't already covered in the previous problems. Now, another part of the chapter that is not this is not assigned, but I did want to discuss it, relates to long-term contracts under either the completed contract method or the percentage of completion method. So I encourage you to read in the text and watch the videos and the PowerPoints to get up to date a little bit on the long-term contract. But I did want to spend a few minutes just going over an example of the long-term contract, since I went through the first part of the chapter pretty well on those problems that we just went through in this video and in the previous video regarding performance obligations. Generally on the long-term contracts, however, there generally is only one performance obligation, because if you're building a building or an airplane for your customer, generally the components that go into that are not separable, right? The electrical system in a Boeing jet, for example, is of no value to American Airlines by itself. That's also true of the computer system, the computer programming, the seats. All of those standalone items generally would not be sold separately to an airline. So within the context of the contract to American Airlines, for example, they're interested only in receiving the completed airplanes. That is then, therefore, a single performance obligation. So on these long-term contracts, we generally don't have to worry about parsing out standalone values to a bundled price, because there is only one performance obligation. So in this case, as I said earlier, you can either record revenue and gross profit on a long-term contract when the contract is completed, which is not as common as recognizing partial revenue and partial gross profit over the life of the contract. So it's this latter example that we'll be spending most of our time on. That is a long-term contract where we're going to use a percentage of completion method to recognize revenue and gross profit over time. But there are some new accounts in this part of the chapter that we maybe had not have heard of before or seen. So I just wanted to run through that, as well as the process of how we calculate and allocate revenue and gross profit over the life of the contract. Here we have a contract. This is in your textbook, illustration 625. Here's a contract where we're going to use a percentage or partial recognition over time to pull in the revenue and the gross profit. One of the things we're going to use in this case is the construction costs as the basis for determining what proportion of the revenue and gross profit we can recognize each year. So in the first row, we're going to just list the construction costs during the year, and then any construction costs in prior years. So in year one, of course, we had no prior years. So the cumulative construction costs are $1.5 million. Estimated cost to complete at the end of the year. This is the estimate for the rest of the contract. So the estimate for the rest of the contract, as of the best information we have of 2021, is $2,250,000. So if that's what we think it's going to cost us to complete the contract, and we've already spent $1.5 million, then we estimate that the total costs on this construction contract will be $3,750,000. Again, that's based on the best information as of the end of 2021. We'll talk about the billings and the cash collections a little bit later. Over to 2022, again, the second column, we list the construction costs incurred that year. This is $1 million in this case. And now we're going to also consider any previous year's recognition. And So in 2022, you can see that we had the total estimated and actual construction cost of $4 million, which includes at this point all of the accumulated actual costs plus the projection for next year of 1.5. So the cost of the contract has gone up. And then finally, in the last year of the contract, we're going to pull in row 1 here where it says construction costs incurred during the year. We'll pull in the 1.6 million actual incurred plus the 2.5 million incurred in the previous 2 years. And we now have total cumulative actual construction costs of 4.1 million. Nothing to estimate at the end of the year 2023 since the contract has ended. So that is then our total estimated and actual cost for the 3 years. Now the billings that we make are our request for payment, and it's usually stipulated in the contract as to when we'll receive payment throughout the term of the contract. And of course cash collections are what we collected against those billings. Now when we do the journal entries for this is where we're going to see some new terms, some new accounts. One is called construction in progress. Construction in progress is an inventory account. So this is where we're going to house all of our costs, the actual, and we're going to also include in the construction in progress account the allocated gross profit as well, which is something that we're not accustomed to doing. But in these long-term contracts, that is exactly what we will do. Getting down to the billings, the billings on construction and contract account, that is new as well. That's a contra account to this construction in progress account. If we're asking for payment, we're creating a new asset, accounts receivable, of 1.25 million. But this 1.25 million is already captured in the construction in progress account. So unless we have this contra account called billings on construction in progress, we'd be counting this 1.2 million twice. So when we ask for money, we send out the bills, we have an accounts receivable recorded, and then the contra asset account, which is contra to the construction in progress account, will offset the 1.2 million in the receivables, or more accurately in the construction in progress account. And that way we will not be counting these assets twice. So the billings on construction contract is a contra asset account. And then we just demonstrate the cash collection. The revenue on the contract is going to be the $2 million that we'll recognize. And I'll go through an example of how we determine the $2 million. In this scenario where we have a 3-year contract, we already went through the costs incurred. Now we can use those costs as a basis upon which to allocate the contract revenue and the gross profit on the contract. So let's look at 2021. Gross profit we recognize. We know that we have those costs that we incurred throughout each of the 3 years, and which we went through earlier. At the end of 2021 is that we think that we'll have another 2.25 million, which we mentioned. So our total estimated and actual cost as of the end of year 1 we think was 3.75 million. Well, if we incurred 1.5 and we have 3.75 total million dollars, then that's 40%. 1.5 mil divided by 3.75 million. So 40% therefore of the $5 million contract price should be recognized as revenue. And that's what we did below. We credited revenue from long-term contracts at the end of year 2021 using the percentage of completion method at $2 million. We're going to book the cost of construction, which is similar to a cost of goods sold or an expense account, at 1.5 million that we have at the top row here. And then the difference between the two is our gross profit. And the gross profit is recognized in construction in progress. Next year we'll repeat this process, but when we make these calculations, we have to deduct what was already recognized. So if we already recognized $2 million of revenue on the $5 million contract, then we don't want to recognize that again. So at the end of 2022, we have accumulated 62.5% of the total cost on the contract. Therefore, we'll recognize 62.5% of the total contract price as revenue. And then from that $3.125 million, 62.5% times the $5 million, we're going to deduct the $2 million already recognized. So in 2022, we'll recognize an additional $1,125,000. Pull in the costs on the construction, which is our very first row again of $1 million this year in 2022. The difference between the two again, we'll book that gross profit into the construction in progress account, and we'll repeat that process for 2023.